Good afternoon, everyone, and welcome to our first quarter capital markets webinar. It was a big quarter. We saw the return of equity market choppiness. Fixed income land was challenged with interest rates, inflation, and more. And of course, we had all kinds of macro risks disrupting financial markets near and far. There's a lot to cover, and I think we got a good event. So first, I want to say my name is Jerry Guger, Head of Content Strategy at Manning & Napier, focused on bringing you the unique views and perspectives of our firm. And I'm joined in here today by Jeff Ingraham, Managing Director of the Portfolio Strategies Group at Manning & Napier. Jeff, welcome.
Yeah, thanks, Jerry. Very glad to be here.
And our agenda today is as follows. First, we're going to do a brief review and really an update on our 2022 outlook, what we covered in early January when we laid out our thoughts and perspectives on the year. Some has changed and some hasn't changed, and we're going to go through that at the beginning. And then we'll do a brief performance preview, and we're happy to field any questions you may have as we go through that section. And then afterwards, we're going to do a Your Questions Answered, and then we'll leave some time to field live questions and answers at the end. And as always, I would remind everyone, we will not be walking through each and every asset class, but instead we're looking to update our overview for all of you and share some insights along the way in the process. So with that, Jeff, where to start? I think we got to start with a later cycle economy, so to speak, and maybe a Federal Reserve that's playing a bit of catch up.
Yeah, I mean, where to start? Great question, right? It's been what feels like a long quarter. A lot has happened. I mean, look at the title of the webinar. We could talk about war. We can talk about oil. We can talk about inflation. I think really where it makes sense to start is on monetary policy. We saw a meaningful shift over the last few months. So towards the end of last year, the Fed was talking about a balance sheet tapering that would go through the first half of this year before they would eventually start hiking interest rates. And the market was thinking maybe 25 basis point hikes, taking rates up to 1% by the end of the year. I think a lot of the economic data that was coming in made it clear that the Fed was behind the curve, as we note on the slide here. They dropped the use of the word transitory in December when they were describing inflation. And now tapering ended in March. Fed rate hikes immediately followed, right? We have 25 basis points in March. The market is now expecting the Fed funds rate to reach 2.5% by the end of this year, including a couple 50 basis point rate hikes, which would be the first time they've done that in over 20 years. So the chart here is really the proof that the Fed is behind the curve. So we're already at an incredibly low starting point, right? Keeping rates at zero. The labor market is incredibly tight. There's a number of data points we could point to here. We're just showing the unemployment rate. Economic growth is already quite strong given the pent-up demand and the reopening of the economies. And it was already showing signs of a natural deceleration. And then inflation is the one that's garnering all the headlines, substantially higher at this point in the cycle, and the main reason for the criticism towards the Fed.
Yeah, and let's dive right into inflation. Substantially higher for this point in the cycle, but also substantially higher by really any type of multi-decade look back, really going back to the 70s or 80s.
Yeah, you got to love inflation. There are literally dozens of ways, apparently, that it can be measured, right? So you have the consumer price index, or CPI. You have the Fed's preferred measure, which is the personal consumption expenditures. We can call it core and exclude things like food and energy. You can measure it on a month-over-month basis, year-over-year. Let's look over longer time periods to sort of remove the pandemic effect. You have median, mean, sticky price, all these different ways to measure inflation. It reminds me of a famous saying that Mark Twain had, which was, there are lies, damned lies, and statistics. And so no matter how creative the statisticians or economists want to be on inflation measures, I think it's clear that prices have accelerated meaningfully across a wide variety of items, not just in the US, but globally. And now there are significant concerns around how bad is it going to get and how sustainable is it?
Yeah, that word sustainable. So we want to unpack that in two ways. And first, we do want to dip back into that word, the naughty word, transitory. Can you talk a little bit about how much of this is transitory or not?
Yeah, I mean, you have to go back and sort of, where did all this start, right? So there was clearly, from a consumer perspective, a shift in spending on goods over services during the pandemic. You combine that with supply chain issues, and the Fed said, okay, well, this is going to be temporary, right? It's just sort of reflective of this pandemic-induced environment, and that's why they're calling it transitory. I think it's become clear that these issues are proving to be more persistent than was originally anticipated. And I think it's fair to say at this point that most businesses, nearly all consumers, have faced some sort of supply chain related issue or bottleneck in one form or another over the last 2 years that still remain here today.
Yeah, and some of this still may roll over. I know this morning there was a used car report from Manheim that showed a little bit of negative price changes on a month-over-month basis. So it might still roll over, but really, it's not that kind of month-to-month stuff that's really catching our eye. It's the longer term. And what makes inflation sustainable, Jeff?
Yeah, I mean, the labor market dynamics right now, that's the biggest wild card here. The term the Great Resignation, right? That's used to describe the fact that we've had this drop in the labor force participation rate throughout the pandemic. And that they've attributed to people retiring early, households figuring out that they could subsist on one income, a single income. You had the stimulus payments and the enhanced unemployment benefits that allowed people to save extra money or actually earn a higher income when they were unemployed. And then you also had limited childcare options, right? Whether it be in schools or a traditional daycare setting that forced parents to exit the labor force. I think right now we've seen some encouraging signs recently that the participation rate is starting to tick higher. And it's basically just kind of a reversal of the things I just mentioned. I mean, one of the things is that higher starting wages, particularly at the low end of the labor scale, the wage scale, you can see it here, is a motivation for people to get back into the workforce. But on top of just the sort of higher starting wages, certainly you have the pressure of increasing prices as everyone's feeling it at the pump and at the grocery store. And a lot of people have exhausted the excess savings that they may have built up during the pandemic. So I think that the trends in the labor market are really going to be maybe the deciding factor as to the sustainability of current inflationary pressures. I think just one comment to make is just that there are several reasons to believe that this is not going to be the type of inflationary wage price spiral that we experienced in the 1970s. But at the same time, it's unlikely that we revert all the way back down to the sub 2% level that we enjoyed in the 2 decades leading up to the pandemic.
Yeah, and let's unpack a couple of the reasons why that might be. And if we take a step back and we say, okay, what happened in March of 2020 or the preceding several months, if not years from there, there was a massive government response, both fiscal and monetary, and that is either unwinding or, if not, becoming a bit of a headwind.
Yeah, so the way we've described it is that the era of peak liquidity is behind us now. And so as those tailwinds have faded, new headwinds have emerged. So what is that peak liquidity? It was that dual thrust of ultra accommodative monetary policy combined with unprecedented fiscal policy in terms of its sort of scope and scale. And this was conducted on a global basis, but the US sort of really stands out amongst the other major economies when it comes to the liquidity that was provided. You can see it here on the chart. And what was initially sort of a 2-year phenomenon, right? 2020 and 2021. And again, the Fed interpreting that as being sort of transitory. I think it's become evident that the inflationary forces are either more persistent or greater than what was originally anticipated. And again, the Fed is now trying to play catch up with that.
Yeah, and so as they go to play catch up, the question, I guess, is how much catch up? Where does that take them? Where will they land?
Yeah, I mean, so it's clear that the Fed or monetary policy most heavily influences the short end of the curve. And as you can see here, markets are already pricing in a much more aggressive Fed tightening campaign, and it's reflected in a rapid increase in the 2-year Treasury yield, right? That's sort of the time frame over which the Fed is expected to be increasing interest rates. The longer end of the curve is higher as well. I mean, the 10-year Treasury is up over 1% just this year alone, but it hasn't increased as much as the 2-year Treasury yield, right? So we find ourselves in this situation right now where the curve is inverted, right? So you see these stories and headlines galore about how an inverted yield curve has preceded every recession over the past 40 years, right? So just a few comments on that. I think that the Fed has only just begun to tighten interest rates, right? So a lot of this is simply just the expectation based on current rhetoric and the financial conditions, but it also leaves a lot of room and a lot of time for things to change. The other thing is that, the timing from when the curve inverts to when the recession actually follows is not very reliable or consistent. So it can range from a few months to a few years. And it's not usually Fed policy itself, right? That's just one sort of contributing factor, but it's often not the catalyst that tips an economy into recession. So often there's some sort of exogenous event that really sort of pushes things over the edge. And there's also a lot of other leading data points, in addition to the inverted yield curve right now, that are not signaling sort of concern on behalf of investors or that recessionary conditions are in the horizon.
Yeah, exactly. And let's talk about one of those indicators. And this is a bit of a classic chart. Corporate credit spreads. We're looking at investment grade. We're looking at high yield. And what we're not seeing is the kind of stress that would say, hey, a recession is imminent or a recession is on the horizon. If anything, we're still scraping at near historic lows as far as credit tightness. Additionally, it also jumps out to me at the very least that when you look at this type of credit spread look back, 2011, maybe the taper tantrum, EU debt crisis, everything that was going on with Greece, 2016, and the collapse of manufacturing at the time. And you can see spread widening there. Neither of those ended up preceding recession, and corporate credit spreads still ended up regressing. So another data point in that favor. And while we're on the topic of sharing data points that don't necessarily suggest imminent recession, this is a bit of a lagging indicator. So take it with a grain of salt. But if anything, when you look at historic charge-off rates of corporates and consumers, it's showing historic health, really, if nothing else. And if you even look at, trying to find recession indicators out there, looking ahead of the curve, again, I'm going to go to this morning from Constellation in Conagra. We had some earnings reports citing ad dollars getting pulled back. We know ad spending, something that's notoriously cyclical. All right, look, I'm trying to find recession data points for you. Here's a couple of them, but really it's still a little bit anecdotal. Additionally, we talk about all these different, cyclical factors. We still can't lose sight of the secular story either.
Yeah, I mean, so, we shift a little bit here from the economy and sort of financial data to, well, what are return expectations, right? How should we expect things to be from an investor perspective? And just starting in the fixed income market, I mean, there's a very tight relationship historically between prevailing yields and the realized return that you get over the following 10 years. And so despite the increase in interest rates so far this year, yields remain low from a historical perspective, and investor expectations for returns from fixed income should reflect that. The area that's shaded gray here indicates the current yield environment. So that's call it a 2.5% to 3% yield today. So really that's the best estimate for a realized return from this asset class over the next 10 years. Just to put it in sort of a brief comparison, in the 1980s, the return to the Bloomberg Ag was 12.5%. In the 1990s, it was around 8%. In the 2000s, it was 6%. And in the 2010s, it was 4%. So that has been just the general trend, and it's been going lower and lower. And I think that's the expectation going forward from here. The other point I would just make is that forward returns can also have a lot of volatility over that 10-year period. So this year, I think, is a perfect example of that. The broad US fixed income market peaked in August of last year. So we are currently right now in the longest and the largest drawdown for fixed income over the past 30 or so years. The Bloomberg Ag is down about 9% from its peak. And bonds had an even worse negative return this quarter than stocks did, which is not something that you see very often. And just looking again, historically, there have been very few calendar years where you've seen a negative return in the fixed income market. And there's never been 2 consecutive years of a negative return. But the ag was down about 1.5% last year, and it's down 6% this year already. So needless to say, it's been a very challenging environment for fixed income investors these last few months and quarters.
I'll also say it's a bit of a joy to lead one of these with fixed income before we get to the other side of the coin, but we know many of the financial professionals on this call, you're thinking in terms of multiple asset classes. So Jeff, can you talk about what you see from a valuation perspective on equities?
Yeah, I mean, there's a lot of different ways to sort of analyze valuations in the equity market, and each of them has its own merit. We've got 4 listed here. So the most traditional is probably price to earnings, which is the first one. You have price to sales, price to cash flow, and price to book value. And it's sort of a helpful tool, I guess, to inform return expectations. But I'd caveat, it's certainly not as tight of a relationship as starting yields and 10-year returns for fixed income is. But as a general rule of thumb, higher valuations will typically lead to lower forward returns and vice versa. So the US equity market, represented by the S&P 500 here, is expensive, right? It's trading at a high valuation relative to its history on every one of these metrics. And I think it really says 2 things. I think number one, it says that some of the return that investors have enjoyed over the last several years has simply come from multiple expansion or an investor's willingness to pay more for the same dollar of earnings. And that's not necessarily a sustainable source of return in the long run. I think the second thing is that any reversion back to a normalized range of valuations is going to be a headwind for forward returns. When you look outside the US, equities are more attractive from a valuation standpoint, relative to their own history as well. And they're trading within sort of called a more normalized range. But the reality is, international companies have not been able to grow revenues as quickly as US companies. And broadly, they are less profitable. So lower valuations are simply a reflection of those dynamics. So on face value, maybe it seems like the high valuations won't be a headwind to international equities, but they also face a lot greater risks to their economies, I would say, from the sort of current war in Ukraine and its impact on food and energy prices. So I guess maybe these factors will sort of even out and will offer similarly challenging returns for non-US equities.
And this next visual almost makes 2 of those exact points that you just made. So not to belabor them, but you can see the difference in the economic makeup really of the US in this multi-decade secular trend towards higher profitability. That's the services, that's kind of the crown jewel, mega cap innovators that we have here, underpinning some of that valuation expansion that you're seeing.
Yeah, I mean, you could say that, hey, look, higher valuations on the US equity market reflective of higher profitability, but it's worth pointing out we're talking about peak profitability right now. So profitability levels are at their highest that they've been. And we're talking about pressure from input costs, whether it's labor or energy costs that are certainly going to pressure some of those margins.
Yeah, not to mention other longer term trends such as globalization, the trajectory of union membership, automation. There's a lot of concerns that something like this could sustain. So, turning now to more putting all of the pieces together in the overview itself and updating the overview. When we were bringing this chart back from 3 months ago, because we got such positive response. And just to break it down for anybody who hasn't seen this before, this is a 3, 5, and 10-year return look back as of the end of the quarter. And you can see the return range and how strong returns have been compared to the broader history. And, we're taking off the 5 and the 95 percentiles to kind of get a more narrow, normalized, middle ground. But you can see, especially on the 10-year, it's been an extraordinary run.
Yeah, I mean, so, part of the outlook really is to be a little bit more cautious, a little bit more defensive, maybe a little bit more negative on return expectations. That's sort of balanced by the reality that we've had an incredible run in the equity market over the last 3 years here specifically. And so what we've been saying is, look, if you're an investor, your balance is higher right now. You've enjoyed that. You've enjoyed above average returns. So sort of a return to a more normal return environment, unfortunately, might mean a negative return or lower returns in equity classes, equity asset classes and other asset classes. But the reality is we've had a tremendous run in markets.
Yeah, and then broadening out even longer than that. And this is a 30-year look back, and we're actually looking beyond just equities now. We're looking at a portfolio of stocks and bonds. And then comparing it to, okay, you say, what do you think might be a realistic expectation going forward? And, I don't know what word you want to put to it, but I don't know if great is the word I'd use.
I'd call it managing expectations, yes. I guess, right? So, historically, basically just using this chart, you say, look, you can expect the same degree of risk or volatility, but you're going to get lower returns in the current environment. That's the reality of what this chart is saying.
Yep. So that broadly is, I think, what we would say is the overview. And so what can you do about that? For us, it's be active, it's be tactical, and it's manage risk, especially if we get a continuation of the kind of choppy environment. The market takes some legs down, it takes some legs up, and it's moving with more veracity than I think we've seen in quite a while.
Yeah, I guess I would just say the more tools you have, the better right now when returns are challenged.
Yep, absolutely. All right, so with that, a bit of a performance preview time, and really this environment, we've alluded to it, it's kind of had a little bit of a barbell hollowing out of the middle for what's occurred over the past quarter, and we'll show that, really right now. And it's been a changing of the guard, and you can see obviously the growth value is what jumps out, if not necessarily the negative returns themselves. I don't think that there's anything particularly noteworthy on the small cap versus large or the international versus domestic necessarily over the quarter, but the longer term trends stand out as well. And this is just on the equity side.
Yeah, I mean, so these are just the equity returns. You can see obviously the first quarter was very different from what the longer term returns look like. The one thing I just point out, and I referenced it earlier, the first quarter was one of those rare occasions where equity returns were negative and broad fixed income returns were even more negative, right? So the Bloomberg aggregate index actually underperformed the S&P 500. That's only happened 3 times since 1976. Ironically enough, they were all in the first quarter of the year. It was the first quarter of 1980, first quarter of 2018, and the first quarter of this year.
So what does that mean for portfolios? From a multi-asset class standpoint, there wasn't really a lot of room to hide.
Yeah, I mean, the subtext here really says it all. Multi-asset class portfolios were challenged during the first quarter with negative returns across both equity and bond markets. As a result, what you see is that what are, I guess, traditionally considered more conservative multi-asset class portfolios were down more than the S&P 500 during the quarter. Within our max strategies, or multi-asset class strategies in particular, they pretty much performed in line with benchmarks during the quarter. I think a few things to note, and this will be sort of a consistent theme, I guess, across a variety of portfolios that were headwinds, was just a lack of exposure to the energy sector, which we largely started exiting at the end of last year. And energy was by far the best performing sector, up over 25%. And the other aspect was just an overweight to what we call sort of quality growth companies, which, as we showed earlier, generally lagged value and the broader market during the quarter. But the intermediate and long-term track records of these strategies still remains quite strong.
Yeah, absolutely. That kind of turning away from quality growth for at least a short period of time, maybe emphasizing some of those junky cyclical names, or perhaps certain large cap electric vehicle automotive companies as well. From an all equity standpoint, again, similar themes.
Yeah, similar themes. The all equity portfolio slightly lagged the benchmarks during the quarter. I mean, the non-US equity portfolio displayed a little bit more noticeable amount of underperformance. Again, similar themes, the lack of energy exposure, overweight to quality growth names. The non-US portfolio had some detraction from stock selection, but it was particularly from a few stocks that have been multi-year sort of outperformers for those portfolios. And once again, intermediate and long-term track records, these strategies remain quite compelling.
Yeah, we're almost putting ourselves in the worst possible light here. And then on a specialized equity standpoint, disciplined value and international small cap.
Yeah, so the disciplined value portfolio performed the best on an absolute basis across the multi-asset class and all equity suite during the quarter, given its focus on large cap and generally sort of value style companies, which were 2 attributes that held up pretty well during the quarter. The Rainier International Small Cap strategy has the most, what I'll call pronounced exposure to growth of all the portfolios. And on top of that, the style dispersion between growth and value was more pronounced in the international small cap market. So that certainly contributed to some of the relative underperformance. And then similar to our non-US equity portfolio, the Rainier strategy also experienced some of the multi-year contributors to performance selling off in the first quarter in particular. And again, similar comment, the intermediate and long-term strategies remain quite compelling. And for the Rainier strategy in particular, it did reach a 10-year track record during the quarter.
Yeah, and again, you see that emphasis throughout all of these strategies. Our particular bent towards quality and fundamentals and our valuation disciplines, and to some extent, it just was briefly out of favor for the quarter. Nevertheless, certainly happy to celebrate the strategy's 10-year anniversary. And if you have any questions, please feel free to reach out. So with that, let's turn to some questions that were already sent to us. And I do want to again thank all of you that pre-submitted questions ahead of time. They help us, help you, help me, help you, Jerry Maguire. But we really do appreciate it. And we want that to help drive what we can present to you here. So with that, and it's no surprise that a number of them were regarding major geopolitical turmoil. So we'll try to tackle them in kind of bits and pieces. And so first, an advisor asked, how have alternative forms of money performed recently?
So I had to chuckle a little bit when this one came in. I was glad to receive it. I think if you'd asked a lot of what I'll call the hard money enthusiasts to describe sort of the ideal environment for these types of alternative forms of money to outperform, and you told them, look, there's a war in Europe, geopolitical tensions are at multi-decade highs, inflation's at its highest level in 40 years, and there's been a weaponization of FX reserves in response to Russia's invasion of Ukraine. And yet gold and what we'll call digital gold or Bitcoin have barely moved on these events. So it has not exactly been the outcome that I think a lot of the hard money enthusiasts would have expected.
Additionally, we got a lot of questions about oil prices specifically. Jeff, I'll ask you, will higher oil prices inevitably lead to a recession?
Yeah, I mean, the reality here is history says yes, right? If you go back historically and you look at any time you've seen sort of a surge in energy prices, and so we'll define a surge here as a 20% year over year increase in energy prices, a recession has soon followed. I mean, the one time period where that didn't happen is the sort of the decade of the 2000s, where China was really doing massive investment in its economy, and that was the commodity super cycle. So outside of that time period, you can see a lot of the spike in energy prices historically have been met with recessions. And I think on top of that, you have tightening financial conditions that we've already talked about. So, I mean, I guess the short answer is if you base it on history, yes. But, they say history doesn't repeat, but it rhymes. So it's tough to say exactly when or how this all plays out, but it is definitely easy to say that tighter financial conditions, higher energy prices are headwinds to economies.
And one more question that we received is kind of an impact from the Russian invasion of Ukraine. And those nations tend to be a bit of bread baskets, as I understand. And Jeff, correct me if I'm wrong, but the question is, will rising food prices drag down the economy?
Yeah, I think I heard something the other day, a report saying that between Russia and the Ukraine, they export somewhere between 15% of total calories consumed in the world. So certainly huge exporters of food. Energy and food are very interrelated. About half the operating costs within the agricultural space is attributed to energy. And so I think that the real challenge here is for a lot of developing nations, and you can see it listed here. So we're already seeing increases in food prices, and that's just in dollar terms. You convert that into emerging market currency terms, because a lot of these commodities trade in dollar terms, but at the end of the day, the cost to emerging market consumers is in their own currency. It's even worse given the strengthening of the dollar. So the combination of rising energy prices and rising food prices on a lot of nations where 50% or more of their budget is spent on those two items, again, massive headwinds to those economies.
And then lastly, Jeff, I think we're starting to get towards that time of the year again. I guess I say year, it's really more of a biennial event, but we got a question. How are you thinking about the upcoming midterms?
Yeah, I mean, I think if you go back to the beginning of this year, again, sort of pre what's happened in the energy markets, what happened in Ukraine, it would have been all about sort of Fed policy and the midterm elections. So I think midterm elections have taken a little bit of a backseat given the recent developments. But if history is any guide here, midterm election years tend to introduce a little bit more volatility into markets. So we just looked at midterm election years going over the last 60 years, and you can see the intra-year decline of the S&P 500 is around 17% on average. So far this year, the worst sort of drawdown so far for the S&P has been about 11%. So if history is a guide here, we're likely to see more drawdowns, more volatility in the S&P 500. I guess the good news that comes out of this is once the dust has settled and we know the composition of government for the next 2 years, it's generally been more favorable to equity. So the return 12 months out of that low point in the market, you've more than recouped those losses.
It just seems to me, Jeff, is another reason to be active, to be tactical, and keep your hands on the wheel.
Yeah, I think that's really the message here, right? There are a lot of challenging things that economies and markets face right now, but it's also incredibly dynamic, right? There's a lot of things that are changing every single day. So again, the more tools you have at your disposal, disciplined investment processes, experience, I think all those things contribute to successful outcomes.
Yeah, absolutely. Absolutely. All right, so with that brings us to our live Q&A, and we encourage you all to submit questions that you have at this point, and we'll get to as many as we can. And while we wait, I do want to quickly mention that we have a number of resources on our website, and we encourage you all to take a look. We just recently published an FAQs with our tech team along with the webinar, because we know that the sell-off in growth that we highlighted earlier has been such a concern for so many of you. So we encourage you to take a look at that, as well as other resources, including pieces on supply chains and logistics networks, inflation, real estate, and more. And so with that, I'll also mention that there will be a survey link that we'll post in the chat, and we encourage you all to fill that out as well, because that helps determine for us what exactly to share on these events. So with that, Jeff, I want to turn it over to you, and I'm looking at a question here, and it is, what changes have you made during these turbulent market conditions?
Well, it looks like I lost my camera here, so that was one change that I made during the turbulent conditions here. Yeah, so I alluded to this earlier, that we've been looking to be a little bit more defensive in our portfolios. We'll call it de-risking the portfolios. So for us, what that looks like is, where we have the ability to manage the asset allocation, reducing our equity exposure, and within that, really sort of concentrating the equity portfolio in the companies that we call profiles, who have the sort of negotiating power with their suppliers, the pricing power with their customers and their consumers, to really be able to have the more sort of durable business profiles through a challenging environment.
And while we navigate the camera, I do want to ask another one, and I'll give you a second here. We've got a listener asking, what role do bonds and bond funds have in a diversified portfolio for the next 1 to 3 years? And really, this is a conversation about the chart that we had showed earlier, which is the fact that low starting yields lead to a challenging forward return environment. But with that said, investors shouldn't overlook the risk management aspects that bonds can provide, right? We know that we're in a period where equities could be choppy, and should that continue, it's important to have elements of your portfolio that can act as, a Bayesian in that type of situation and provide a little bit of downside protection should that continue.
Yeah, I mean, fixed income has two main roles in a portfolio. Number one is it generates income, right? So for those that are making withdrawals from their portfolio, is a consistent source of income in your portfolios. Number two, it's generally a ballast for challenging equity market environments. The historical, again, talking a little bit more long-term, but historical correlation between bonds and stocks tends to be zero or even slightly negative. So when stocks are going down, bonds are generally appreciating in value. Certainly that was not the case during the first quarter, but as I highlighted earlier, it was one of those rare circumstances, right? There's only been 3 quarters over the last nearly 50 years where you've had the type of outcome that we saw this first quarter. So I think there's still a role that bonds play in a balanced portfolio, again, from both a diversification and income standpoint.
Jeff, this is a bit of a long one, so if you can bear with me, I'm going to read it word for word here. I'm an advisor, and I am no longer certain that standard deviation is the best measure of risk. I'm starting to look at other statistics, and I'm curious to know if you guys use or look at upside, downside capture, drawdown, Sharpe ratios, etc.
Yeah. So I think standard deviation is useful when thinking about an asset class, because it really sort of sets the parameters of what are the potential return expectations here, right? So for stocks, you've got an average return of 9 and a standard deviation of 15, 16, 17. So that really sets the sort of high low of the return outcomes that an investor could experience. And that has use, right? That has use in informing different asset classes. I think from a behavioral standpoint, though, there are a variety of other risk metrics that also provide value. Downside capture is one of them, right? And it's one of those where we're human beings. We hate losing money. We have an aversion to loss. So you have to be real sensitive to sort of the behavioral dynamics of investors. And downside capture is a great way to show that, okay, in down markets, this strategy tends not to go down as much. Right. So that's a great way to sort of capture a risk statistic that is more aligned with, I guess, behavioral aspects of investing.
Yeah, and another thing too, Jeff, that jumps out to me when I look at this question, we talk about it all the time, and that's investing is the intersection between art and science. And these are incredibly useful tools that should be used, but we shouldn't lose sight of the art either. And whether that's running Monte Carlos on a financial plan, or NPT stats on asset allocation, models that you build, DCFs for individual securities, there's a qualitative and a quantitative aspect to this stuff that has to fit together. All right, and with that, that is unfortunately all we have time for today. I appreciate everybody taking the time to attend today's webinar. A couple of reminders: we will submit a recording of this shortly after, and you'll receive an email with all of that. We will also send out an email of the survey, and we encourage you all to fill that out and let us know how we did and what you'd like to hear more of next time. And with that, Jeff, thanks for being here today. This was fun.
Yeah, I love doing this. My pleasure to be here.
Thank you, everybody, for attending today's webinar.